Hello there. We call this the pulse because the idea is we keep our finger on the pulse and we keep you up to date with what's going on in the fast-moving world of finance. But sometimes the world of finance can move even faster than makes everyone feel comfortable. When I first sat down to draft the written version of the pulse last week, I was writing a piece about how the economy was doing a lot better than expected and what implications that might have. But things have moved on since then, and since then we've had the news about Silicon Valley Bank potentially, well, basically going out of business. So what's going on? Well, just very, very briefly, this is a small bank in Silicon Valley, caters mainly to tech firms. Unlike when a bank normally runs into trouble, Silicon Valley haven't had any kind of loans go bad, for example. What they had instead was potential losses in some of the capital they held. So like most banks, they take in deposits and they hold capital, or they sometimes lend out money. And the capital they held was held in long-dated government bonds. Now, as we all know, if you've been watching the markets over the last couple of years, the price of those bonds has really fallen quite sharply as interest rates has gone up. So Silicon Valley Bank decided they were going to raise some more capital to try and shore up that balance sheet. And that was possibly a mistake because that might actually have kind of alerted people to this issue. Because if they hold those bonds, those government bonds, until maturity, there's not a problem. They will mature, they'll get their money back because they're guaranteed generally by the US government. But if they have to sell some now, then the price that they get would be quite significantly below that. So this, a few investors worked that out, and then essentially it went viral that people were starting to tell other firms, all the tech firms, started to take their money out of Silicon Valley Bank. And then we ended up with an old-fashioned bank run. And no bank can survive a bank run, so essentially they're out of business. The problem is then what happens and what does the knock-on effect, as always. If a bank goes out of business, who's losing their money? If depositors lose their deposit, they can't pay their bills, they can't, if you're a company, you can't pay your staff, you can't pay your creditors. Maybe the bank owes some money to another bank. Maybe there's a knock-on effect. So the US authorities had to step in, which they've done to secure depositors, to stand up for depositors and make sure that all those people can get their money back. If you own shares in that bank, then you probably lost pretty much everything. If you own bonds in that bank, then you might lose a lot. But if you just deposited money with them, it looks like you're going to get your money back. But what we've seen over the past sort of couple of days, as I'm talking to you now, is that markets have fallen really sharply over sort of 2% each day as a result of this, and mainly because bank shares have been going down. So what might happen next? Well, it's a very fast-moving situation. We're not sure. But one of the effects may be that the central banks hold off on putting up interest rates any further than they were going to. Maybe if we think about it, it's actually the hike in those interest rates that they've gone up so quickly over the past couple of years, and that's led to losses on the bonds, and that's what's got the bank into trouble. So if I were the Federal Reserve, I might be saying, well, do you know what, I won't hike rates up anymore just in case something else comes out of the woodwork. So that's slightly changed things. Could it be the trigger for an economic downturn? Well, I don't think so, but you don't know because as of yet we're still monitoring things and we don't know who might lose some money as a result of this. So, as I say, very, very fast moving at the moment, and by the time you read the pulse or watch this, then it may well be out of date. Because what I was going to say before all this came out of the woodwork was actually recently we've seen lots of good news. We've seen the economy doing a lot better than a lot of people thought. And that's obviously positive normally for stocks. But it is a bit of a mixed bag because if the economy is doing better than expected, then that possibly means that inflation might be a bit stickier than expected. Headline's going to come down because of the energy prices, etc. But if people have got more money and they're able to go out and keep spending, then that keeps pushing sort of core prices slightly higher. And as a result, we were therefore saying that we thought central banks might be pushing up rates higher than people had thought and maybe keep them there for longer. Now, given what's happened with SBVB, we might be revising that view. We're not quite sure at this moment. But our conclusion to all that is that given it's such a sort of tightrope between the economy and interest rates, where we want to be investing at the moment, an asset class we like at the moment is corporate bonds. We're lending money to companies. because having seen bonds fall quite a long way last year, we're now getting paid quite a good yield. So if interest rates do keep going up, well, we're already starting with a good yield, so hopefully that should provide us some protection. The other risk with corporate bonds is that the company you've lent money to goes bust. But again, with the yields being so much higher than they were a year or so ago, then we think we're getting paid a high enough potential return to compensate us for that risk. So in portfolios, we were looking at whether actually, in some instances, we should be reducing equity exposure in favour of bond exposure. Now, we've done a bit of that already because as defined returns have kicked out, we've generally not reinvested back into equities or back into defined returns and put into bonds or alternatives. So we may well continue to make a bit of a moves in that direction. But with everything so much in the air, with the news around Silicon Valley Bank, we'll obviously need to watch things carefully, and things could be very, very different by the time we get to this time next week or this time next month. So as always, when things are volatile, we'll try and keep you updated, let you know what's happening, and we'll react accordingly. Thanks very much. See you again next time.